All right, welcome back, traders. John Caruso here. March 10th. It is Friday once again here with another quick hitter look at the March S&P 500. We're also going to take a mini victory lap here. If you did check out last week's video, of course, on this big thrust higher that we saw last Friday, we did mention that we thought that that was a pretty opportune time to begin resetting some sell-side strategies in this market. And of course, we have seen a big breakdown on the charts once again this week. I can tell you this, on Friday, a lot of people thought I was crazy for wanting to sell this candle. One of the reasons why we came to that conclusion, number one, we're still working with a very bearish trend in the S&P 500 coming out of 2022. And number two, I still had negative momentum, bearish trend. And of course, I was getting the overbought signal here in the oscillator on the chart. And when I can pair up a bearish trend, negative momentum, in an immediate term overbought situation, I think that's a high probability short in the market. And that's precisely what happened. Of course, we saw the breakdown on Tuesday, saw the rejection on Monday, then the breakdown on Tuesday, consolidation day on Wednesday, and then, of course, the big breakdown on Thursday here. Of course, the talk of the town right now is the voluntary liquidation of the crypto bank, Silver Bank, and, of course, the bank run on assets of the Silicon Valley Bank, SIVB. If you take a look at that market, or if you take a look at that stock, that's a $100 stock that was once a $300 stock just back in February. It's down 66% since February. And right now the market's trying to measure whether or not they're trying to measure contagion risk with some of the other banks. Of course, we did see a lot of the regional banks took a big hit today. And of course, that contributed to the selling. Now, what's going to happen going forward? As you can see here, our projections are only down to about 38.24 on this chart, or the 38.2% Fibonacci. Why do we think that the sell-off is going to be staved off here at 38.24? This is, of course, from a strictly technical look of the market. Of course, we cannot measure or assume the contagion risk of this Silicon Valley Bank nor Silver Bank here in the very near term. But why do I think this market, at the very worst case scenario, could potentially break the 38.24 or the 38.2% Fibonacci? We do have this big consolidation zone from the end of last year that I do believe will hold. And of course, we are looking at a positively configured situation since the October lows here. We did have the October lows. We saw the rally. Then we saw a pullback to a higher low. Market then trended higher in the beginning part of this year, and we did actually make a higher high up here at 42.08. So I do suspect that somewhere down in here, we are going to find some support, and this market is going to find some footing back on the upside as we come out of Q2. That's the call that we're making right now. Of course, if we were to break down through these previous lows of about 3,800 to 37.89, then of course that's going to open up this chart to another peak or another test of the lows, the October lows down along 3,500 in the March S&P. So that's where we're at right now. That's a quick hitter look at the March S&P 500. We still think selling intraday rallies over the next couple of weeks is still the proper way to position in this trade for now. Best of luck to everybody out there. We'll catch you back here next time. Take care.